Welcome to the Financial Market Examiner YouTube channel, where you learn about forex, crypto, and the stock market. On this channel today, we'll learn how to tax capital gain in stocks. If you sell stocks for more than you originally paid for it, you may have to pay taxes on your profits. What is capital gain? A capital gain is any profit from the sale of a stock, and it has unique tax implications. Here's what you need to know about selling stocks and the taxes you may have to pay. How to calculate profit from selling stocks. When you sell stock, you're responsible for paying taxes only on the profits, not the entire sale. To determine profits, take your total proceeds and subtract your cost basis, also known as your tax basis, which consists of the amount you paid to buy the stock in the first place, plus any commissions or fees you pay to buy and sell the shares. Cost basis equals the price paid for stock plus commission and fees. Profits equals the proceeds from sale minus cost basis. Example of how to calculate profit from a stock sale. Let's say you bought 10 shares of stock in company. Let's say you bought 10 shares of stock in company X for $10 each and paid $5 in transaction fees for the purchase. If you later sold all the stock for $150 in total, paying another $5 in transaction fee for the sale. Here's how you calculate your profits. The cost basis equals to $100. That's 10 shares at $10 each plus $10 purchase and sale fee at $5 each. That's equals to $110 profits equals $150 minus $110. That equals $40. So in this example, you pay taxes on the $40 in profit, not the entire $150 total sale price. Now that you've determined your profits, you can calculate the tax you have to pay. The tax you owe depends on your total income for the year and the length of time you held the shares. Short-term and long-term capital gain taxes. Generally speaking, if you held your shares for 1 year or less, then profit from the sales will be taxed as short-term capital gains. If you held your shares for more than 1 year before selling them, the profit will be taxed at the lower long-term capital gain rates. Both short-term and long-term capital gain tax rates are determined by your overall taxable income. Your short-term capital gains are taxed at the same rate as your marginal tax rates. You can get an idea from the IRS of what your tax brackets might be for 2022 or 2023. For the 2022 tax year, the taxes most individuals will file by April 17, 2023. Long-term capital gains rates are either 0%, 15%, or 20%. Unlike past years, the breakpoints for these levels don't correspond exactly to the breaks between tax brackets. Here's how to avoid paying taxes when you sell stock. One way to avoid paying taxes on stock sales is to sell your shares at a loss. Although losing money certainly isn't ideal, losing your income from selling stocks can be used to offset any profits you made from selling other stocks during the year. And if your total capital losses exceed your total capital gains for the year, you can deduct as much as $3,000 of losses against your total income for the year. You can carry any additional losses into the following tax year. However, you can't sell a bunch of shares as a loss lower your tax bill and then turn around and buy them right back again. The IRS doesn't allow this kind of wash sale, called by this term because the net effect of your assets is a wash. To reduce your tax liability, if you repurchase the same or substantially similar stocks within 30 days of the initial sale, it counts as a wash sale and can be deducted. Well, of course, if you end the year in the 0% long-term capital gain bracket, you owe the government nothing on your stock sales. The only other way to avoid tax liability when you sell stocks is to buy stocks in a tax-advantaged account. One way to avoid paying tax on stock sales is to sell your shares at a loss. While losing money certainly isn't ideal, losses you incur from selling stocks can be used to offset any profits you made from selling other stocks during the year. And if your total capital losses exceed your total capital gains for the year, you can deduct as much as $3,000 of losses against your total income for the year. With this, we've come to the end of the video for today. Kindly share with us your feedback in the comment section. There are several educative videos on this channel for you to learn more about the financial market. Note that this video is not for financial advice, but for educational purposes only. Kindly subscribe, share, and like after watching. Thank you.